Strong recession indicators are in the market, but the job report says that we are at 3.6% unemployment. So how can you have a recession? Well, as my friend Barry Habib says, that's what a fool believes. Hey, it's Rick Elmendorf. Happy April Fool's Day. That is not an April Fool's joke. We are looking at a possible recession, but hey, you know what? This is what I'm here for. I'm here to give you the best tools and tips for managing your mortgage and winning that house you love. On this channel, we do a lot of strategy videos and as well as market updates like the one you're watching now to help you prepare for the house buying and all that stuff. So if you're new here, please consider subscribing. So I've been in locking mode since, well, forever, but especially yesterday due to the jobs report that was coming out today. Jobs really kind of set the tenor for where interest rates, mortgage rates are headed. And the numbers came back, you know, as a little bit less than expected. In fact, the report for March showed 431,000 jobs created, which was revised up 95,000, but it's still kind of missed estimates. Additionally, the unemployment rate, which is a biggie, is reduced from 3.8% down to 3.6%. Now you're going to see that this is a pretty major reason why I feel that we're going to be some recession signals, and I get to that in a second. We also had average hourly earnings. These were up to 5.6% and average weekly earnings up 4.6%. So all these are kind of signs that the economy is doing well. But how do you see a recession with such strong job numbers? So now let's go ahead and take a look at something in the charts. And I want to point out just a few very simple facts. Recessions tend to start when the unemployment rate is at its lowest and starts moving higher. So as you see on this chart, and I'll just look at a couple of scenarios here. Obviously, this is back in the financial crisis. We had a pretty low unemployment rate, and then all of a sudden we had a spike in the unemployment rate led to a long period of recession. Now again, if you go ahead and fast forward all the way to January of 2020, we were down all the way down to 3.5%. It's kind of eerily that we're seeing these types of numbers again today. And we had a tremendous increase in the unemployment rate, obviously due to the pandemic. Well, we've also had a significant decline in the unemployment rate of recent, but look folks where we are sitting right now. We're sitting at 3.6%. Now, I want to kind of go into this as to why I feel like this is a recessionary signal. Again, recession starts when the unemployment rate is at its lowest and starts moving higher. Now, I'm going to get into some reasons that I believe that the unemployment rate is going to be going higher, signaling starting a recession. Now, a caveat here, a recession is good for mortgage rates. Mortgage rates tend to love chaos. They love everything bad that happens. We all know that the Federal Reserve is looking to raise rates aggressively in the coming months and years. But what will this rise in the rates do to mortgage rates? So now recently in the last Fed meeting, the Fed announced a quarter-point hike to the Fed funds rate. And how does that really affect mortgage rates? Well, the answer may surprise a lot of people. And I've dealt with this issue before, but let me go ahead and reiterate. The federal funds rate is not tied to the same things as mortgage rates because it can change from one day to another, while mortgage rates can be in effect for 30 years. Now, mortgage rates are primarily driven by inflation, which erodes the buying power of that fixed return that a mortgage holder receives. Okay, when inflation rises, lenders demand a higher interest rate to offset this rapid erosion of their buying power. Makes sense? Now, you probably know if you haven't been under a rock that inflation has been out of control. It's been rising significantly. And as a result, so have mortgage rates. When the Fed hikes rates, they are trying to slow the economy and curb inflation. If they're successful in cooling this inflation, mortgage rates will decline. Now let's look at what's really going on. There's been a major shift to the mortgage markets. Mortgage pricing has moved more in the last 2 months than any time in recent history. So you can see the move in the 10-year treasury here in this chart here. Let me go ahead and load that. And basically, the market is coming to grips with the possibility of multiple 50 basis points Fed raises in the midst of inflation levels that haven't been seen in our country since the early 1980s. And of course, we have the war in Ukraine. Will have additional effects on oil, gas, food that we can't even anticipate yet. So at the same time, we're seeing some structural issues that all market participants are dealing with, such as the agency, what we call loan level pricing adjustment. Let me go ahead and take a look at this chart that is quite outstanding. And I've dealt with this in a recent video. And let me look at a longer time frame of where we are with mortgage-backed securities. Now, this is going back 3 years. Now, you've seen this tremendous decline, is what I just mentioned about, but let me go back a little bit further. And I want to show you something very interesting. Look at this point down here. Now, obviously, as mortgage bond prices go down, the yield goes up, which is bad for interest rates. So red is bad, green is good, down is bad for rates, up is good for interest rates. We see a pretty dramatic difference here. We're talking over 200 basis points difference between where we are now to where they hit the bottom right here in about November of 2018. We've seen such an add-on in the cost of doing business for lenders. The rates that clients were getting back in late 2018, early 2019 are the same that rates are being given to consumers now. The question is valid. Where are rates now and where do we go from here? I will tell you this. I'm going to go back to the charts here. And I'm going to put on a shorter timeline because it's very, very important to see. We're approaching the moment of truth. And this moment of truth is right here at this 101 number. And typically what we have is called levels of support and resistance. And bonds tend to like to trade within these levels. Well, obviously we've been on a slide since, we've been on a slide since January, but rates are starting to really get bad since March. And my fear is, like I showed you in that longer chart, is that we have a long way to go to get to this level here, which makes me very, very scared for interest rates. So for right now, I just see too much risk playing in this market. I'm recommending everyone to be diligent with their bidding on homes. I'm asking them to intelligently be aggressive. I hope this was helpful and instructive. Buy now. Don't worry about rates. Those will fall when we hit a recession. You can refinance them, but you can't refinance. I sound like a broken record. You cannot refinance if you don't own a home. Well, have a great weekend, and I will see you on the next video.